Marcus, can you just tell us the situation now at the moment in the banking, in the debt finance situation? It's getting very tough for 2012. Your bank is one of several that has said they're seriously going to curtail their debt funding. What's the situation currently?
My personal opinion is that 2012 is going to be a very tough year for both our clients and for us as lenders. The whole industry still is looking for orientation. We have to increase our capital adequacy ratios, which puts a lot of pressure on new business and on the existing business with our clients, where we have to look for unconventional solutions.
Development finance requires debt finance as well. Is this a problem or a challenge for mainland, or are you in such a very active and, let's say, popular marketplace in Poland that you can find equity and debt capital relatively, or at least debt capital relatively simply for the development challenge?
It's challenging, but it's not impossible. But the request from the bank and first of all, it's more or less impossible to find only one bank. It's more or less it's quite often the syndicate of the bank. So we have to find the people that they will find the agreement between them. Is the first step. And the second thing that the equity request, it's more high level, and the guarantee. Also we saw during the last month that the guarantee are more and more, the demand is more and more high in terms of guarantee from the bank. I think that in Poland today, it's really very difficult time for the independent developer.
Yes.
Really very difficult to get first the equity, and second to show that you have enough track record to convince the bank that you are able to complete the project in the proper time, on the proper budget, and it is a sustainable project. So it's not impossible, but it takes really a long time.
Ben, how do you see the situation at looking from the Neinvest perspective?
I think what has changed is what kind of KPIs you are looking now for the investors. So at the beginning, when the market was right, people was looking at IRRs, was looking capital values, was looking these kind of measures. But now, to be honest, on my investor side, they are looking more the dividend yield. They are looking more for growth in NOI. They are looking how capable we are to really sustain that growth, more than what is the level of capital or GAV value. Of course, this is a kind of, the investors may be looking at the dividend, but the banks are looking at the JVs. So at the end, you have a kind of a difficult situation.
What are you sort of advising at the moment across the continent? Are you staying with core in Henderson Global, or you really are looking at good secondary locations and assets?
We're very much sticking to core at the moment. I think earlier this year we saw people sort of testing the water, trying to identify what made good secondary, but throughout the course of the summer, when any economic growth sort of came to a halt, people retreated back to the very prime end. I mean, my honest advice to investors is don't sort of disregard any market in entirety due to perceived macroeconomic risk, because I think with retail, it's all about thematics rather than just national geographies. And I'd rather have a dominant, well-anchored shopping centre in Spain than a really poor tertiary one in the UK, for example.
Colin, to you on the same sort of question, looking at secondaries, locations and assets, looking at prime, what's your strategy at Pradera going forward?
Our strategy, in fact, has always been to go or invest in the 2nd to the 10th cities in any country. So we tend to think that the main city in each country gets overbuilt too quickly by developers who come from that city and don't want to travel too far. So we've always found better pickings in the sort of 2nd to 10th cities.
Jan, in Poland, what is your strategy with mainland right now? Are you concentrating down on on Warsaw plus a couple of other major cities, Krakow perhaps. I mean, where are you in terms of development of mainland in this very active marketplace?
We are focused on two different directions. First is to revamp existing shopping mall, means the shopping mall built in the first generation, to extend, to revamp, to repositioning. And the second thing, it's on the big city or on the, I would say, sustainable markets. Doesn't mean only the city, but also the catchment area. We are looking for the new opportunity through the market intelligence, and we are looking in such kind of area which kind of a new product we can bring on the market. So it's not only focused on the city, it's more focused on the catchment area and on the competition. And also, in another end, we are looking to revamp existing shopping mall.
It's going to be even more difficult to find bank financing for secondary assets and locations, presumably, than it is for core. How do you see that panning out in 2012?
Looking at our portfolio, for example, in Poland, I mean, we have financed approximately 80% of our portfolio is in retail. So it's not only core, it's not only in Warsaw, but it's a performing and a very well-established business in our firm. So therefore, you always have to look what is core. I mean, you can be in a B city, but in a trophy location. Is this core, or is this core plus, or is this non-core? In my opinion, as Jan said, it's difficult to find that. And it will be more difficult, in my opinion, in the future, in particular for development finance, because we are in the second cycle of that the lenders are not providing adequate development finance into the commercial real estate market. Therefore, sooner or later, we will see when growth takes place that there will be further demand for space, for new products, for complementary product in different markets. And when this is going to happen, I think then alternative lenders will step up and will be present to take the opportunity and lend for good projects with good clients.